The American dealership experience sells a specific promise of freedom and status. But for millions of buyers today, that promise is ending with a tow truck in the residential driveway. This chart tracks the scale of the current market. Total outstanding auto debt has reached $1.71 trillion. The average monthly payment for a new car now sits at $773, and 20% of buyers are committing to over $1,000 every month. When we look at subprime loans specifically, the risk becomes clear. The 60-day default rate for these borrowers hit 6.9% in early 2026, surpassing the peak recorded during the 2008 financial crisis. A basic tool for commuting has become a weight on the wider economy, driven by shifts in how cars are manufactured and sold. Most dealership lots today appear to have an abundance of inventory, but for working-class buyers, that volume masks a severe lack of affordable options. In 2017, automakers offered 36 different models priced under $25,000. Today, that number has dropped to 4. As this data shows, average transaction prices are nearing $49,000, while the line representing household income growth has remained largely flat over the same period. Because affordable entry-level cars have disappeared, lower-income households are pushed towards larger, more expensive vehicles that their budgets cannot actually sustain. Since the sticker prices have outpaced what consumers can pay, the industry has turned to financial maneuvers to keep moving this inventory. This financial process is finalized inside the dealership's finance and insurance office. The dealer's main goal is to keep the buyer focused on the monthly payment rather than the total cost of the vehicle. This animation illustrates the trade-off. Extending a loan term to 7 years makes the monthly payment look manageable, but it causes the total interest paid over the life of the loan to swell. These 7-year terms account for 23% of all new car loans. Over 5 years, a typical car loses 55% of its value. Because long-term loans pay down principal slowly, owners find themselves underwater, owing thousands more than it's worth. When these buyers need their next car, they often roll that debt, averaging $7,100, directly into their next loan. This structure ensures the dealer moves a car today, while the consumer enters a cycle of debt that becomes harder to break with every trade-in. To understand why these loans are so common, we have to look past the local dealership and at the institutional lenders providing the capital. For subprime borrowers, lenders often set interest rates as high as 18.7%, which generates significant upfront profit for the financial institutions. These high-yield loans are often bundled together and securitized, sold as investments called Auto Loan-Backed Securities. This setup allows lenders to extract profit immediately, while the long-term risk of the car's depreciation is passed on to the broader financial system. The car loan now acts as a primary channel for moving wealth from household budgets into the balance sheets of institutional lenders. For the average household, an expensive car loan doesn't exist in a vacuum. It forces a series of difficult choices regarding other essential costs. This graphic shows what researchers call the debt cascade. When middle-income families carry these auto loans, they often rely on credit cards to cover their other expenses, leading to a 31% jump in their credit card balances. Rising gas prices and higher insurance premiums only accelerate this pressure on the family budget. When car payments consume a fifth of a family's income, that debt begins to weigh on every other part of their financial life. This suggests the auto crisis is not isolated, but a burden starting to compromise the wider consumer credit market. For millions, the math has already failed. Nearly 31% of trade-ins now carry negative equity, and delinquency rates are continuing to climb. This failure results in a surge of repossessions across the country, as tow trucks reclaim vehicles from families who can no longer sustain the cost. These 7-year loans provide a car today, but leave buyers with almost no room to manage a financial emergency or build savings. The question now is whether these delinquencies remain a contained problem, or if they signal a broader contraction in consumer spending power. Share your own experiences with dealership financing in the comments below, and subscribe to Legacy Economics for more analysis on the systems driving the global economy.